Hello?
Yes, sir. Sarvottam here. Just there are 2 more minutes to go, rather 1 more minute to go, and then we will begin. Sir. So meanwhile, we all can be on mute.
Okay.
For 1 more minute.
Sure.
Thank you, sir. Yes, sir. We can start. Thank you.
Yeah, hello? Hello?
Hello.
Can you hear me?
Yes, sir.
Yes, Dokic sir, we can hear you.
Yeah, may I start?
Sachi, you can start now, and you can invite Doke sir to say a few words.
Yes, sir. Good evening and a very warm welcome to everyone. We are glad to have received an overwhelming response and registrations from participants all over the globe. We are indeed honored to connect with all the dignitaries, academicians, industry professionals, and our dear students through our international webinar, Finding Investment Opportunities in Current Environment, organized by the Internal Quality Assurance Cell and the Finance Club of ML Dhanukar College of Commerce. I also feel extremely proud to share with you all that on this very day, that is 9th June 1921, our parent organization, Parle Tirak Vidyalaya Association, was established, and today it has completed 99 years of its glorious journey in the field of education. Our beloved PTVA has now commenced into its centenary year. It's truly an honor to be conducting this event on this special day. On that nostalgic note, we gladly welcome Mr. Rahul Mehra, our distinguished panelist, and Dr. Diem Doke, Principal of ML Dhanukar College of Commerce. We now request Dr. Diem Doke, our respected principal and academician par excellence, to deliver the welcome address and formally announce the beginning of this session.
Hello, thank you, Sachi. Good evening to one and all. I welcome Rahul Mehra, today's speaker. Incidentally, Rahul Mehra is our student also. So we are glad to have Rahul Mehra with you as a student and now as a faculty. As Sachi told, Parliamentary Vidyalaya Association completed its 99th year and today it's entered into 100th year. We had planned a big show, big program, but we couldn't do it due to COVID-19 and we had to do it online today. Hopefully the issue will be solved within a year and closing ceremony, we will have a grand with all of you with your blessings and your best wishes.
Thank you, sir.
Every event, maybe a good or bad, creates some opportunities, creates some problems. So now we have to look towards COVID-19 as what are the good opportunities that we can have from this event? What are the new business avenues, new types of jobs will be available? Other day we had a seminar from artificial intelligence, and he was also of the opinion that due to this, now there will develop a culture of working from home. So possibly more demand for IT sector will be there, or IT and IT business will be there more. Similarly, today Rahul Mehra is going to deliver a lecture on what are the opportunities after COVID-19. I welcome all the participants and thank you, Sachi. Thank you, Rahul. Over to you, Rahul.
Thank you. Thank you so much, sir.
Thank you, sir. We are now geared up for this power packed session. I am privileged to introduce our esteemed panelist for today. Mr. Rahul Rajesh Mehra is a wealth management consultant with over 15 years of experience. What started as an academic interest while studying for MCom MBA has now transformed into his passion as CEO of Padam Financial Investment Services Private Limited, a single window for all financial needs. He has been a professor imparting knowledge on investment analysis and portfolio management. Along with this, he is also a qualified consultant for insurance and mutual funds investment. All these years of experience, knowledge, and expertise have helped him build a strong clientele not only in India but also overseas. As an active associate member of National Stock Exchange and Bombay Stock Exchange, he understands the significance of being updated with the present day market scenario. His YouTube channel, Wealthsmith Talks, has been very well received as well as his blogs. As an ardent knowledge seeker, his endeavor is to spread the power of knowledge through multiple mediums. We thank you, sir, for accepting our invitation and gracing this session. I, Sachi Patil, and my co-host, Ms. Bhagyashree Raut, will be the moderators for this session. The objective of this worldwide webinar is to acquaint the participants about different aspects of seeking investment opportunities during global crisis. This webinar is conceptualized and executed by the students of second year BFM. In these turbulent times, people are uncertain about the economy and are concerned about their investments. This is evident from the 600 plus questions we have received from the nooks and corners of the world. Through our session, we will be covering the frequently asked questions and attempt to address your financial concerns. Sir, we are really glad you're here to answer all the queries that the participants have.
Thank you.
The first question that I have is from Ansh Arora from the United States. And he is asking, what do you think are the sentiments prevailing in the current market right now? Since it is a general belief that sentiments play a huge role for any rally.
Well, thank you for the question. Well, it's a very, very nice question. I'll create a background for what has happened, so far in the markets and how things have, panned out in the past. It's very obvious that the whole world today is, trying to come in terms with a, health, scare, which is the COVID-19 or the coronavirus, which has engulfed the whole world and obviously is hitting the economies of the world very, badly. Here in India, obviously, you have had almost 72, 74 days of, lockdown. So a lot of businesses have suffered. There has been a lot of slowdown within the economy, which can be seen from the PMI data, which has plunged. The GDP, growth estimates for this quarter have gone down to 3.1%. But having said that, it's a very similar kind of, situation all over the world where, the world is said to be getting into a recession. Recession, in a very simple term, is when you have a quarter-on-quarter, decline in the GDP of countries and overall of the world. It is said that the recession is setting in. So, be it developed countries like the UK and the European Union, or maybe the USA, be it Russia, they are struggling. They are the ones who are worst hit. Then there are developing countries like India and China, who are again facing a lot of problem with their engines not totally shut off because of this lockdown. Not that we are not we were already troubled in the last 3 years where economy was slowing down. There were job losses. There was already a lot of problem with the kind of work which was being promoted. So there was a problem, but this is going to get this went worse because of this situation. So yes, the sentiments of people, sentiment of people all around the world is pretty subdued. But going forward, it does play an important role. But as humans, as Homo sapiens, we need to understand that we can adapt to changing situations very fast. What I'm trying to tell you is that there was a influenza kind of flu which happened right back in 1919, which was called the Spanish flu. And it took us around 2.5, 3 years to get out of that. And from there, in 100 years, the world has really, gone much, much different than what it was 100 years back. So here you're looking at a situation where there are so many companies and countries which are looking at vaccines, trying to get out a drug for the same. There is, if you look at a country like Japan or South Korea, they have already gone ahead and taken care of this problem, and they are actually going ahead and starting their businesses. New Zealand, I heard, has not reported a single case in the last 5 days of not a single case of COVID. Plus, if you talk about USA and Europe, the numbers are coming down slowly. So the sentiments will change. Sentiments will go through, I would say, a phenomenal change once the vaccine or a drug is out, the news is out. Things will come back to normal. There will be, a lot of inflow of money which will come into the Indian markets. So yes, sentiments are back, but I think they will change pretty soon. So answering the question, yes, bad now, but it's actually a good time to think about investments.
Okay. Absolutely, sir. This brings us to our next question, which is from Dharangini and Omkar. And they want to know, how do you think the economy will restore itself post-COVID, especially the businesses facing financial crunch?
Oh, well, yeah. Okay. So, here in any kind of a business, there is a fixed cost and there is a variable cost. Okay. Obviously, any business cannot, do much with the fixed, costs which are entailed in their, balance sheet. But then there are variable costs which are there, which can be, tinkered around with. So it could be branding, advertising. It could be, the expenditures which are done by companies for promoting their goods, services. That could be a little bit of, downsizing in terms of, the employees which are there in the organization. So that's where the catch comes. Then there could be work from home. Obviously, we have gone ahead and seen the situation all over the world today, that people are working from home. They are sitting back at home in their comfort, and then they are working, and it is possible. So this is taught us that yes, you can work from home if you have got the discipline, if you've got the kind of mindset, you can do that much easily. So here the companies, one, will have to bring down their cost so that the bottom line and the top line get matched up. So the top line is not going to be that great. Sales are not being done for almost like for 2 months now, but they will slowly and steadily pick up. So that will reflect in the bottom line, which is your profits. The cost has to be curtailed highly. That is one. Second, I think companies will have to think out of the box going forward. They'll have to find ways of logistically reducing their prices. They would have to go ahead and maybe go ahead and take into cognizance the changing time, and look at various options to grow their businesses, be it online, be it offline. But having said that, there are going to be certain sectors, there are going to be certain companies who will do very well with this, with this kind of a change. So I'll just discuss that because that might add a little bit of value to this discussion. The IT companies which are there, that is information technology companies, they are very well poised to take advantage of this situation, work from home, because they are technically very well placed to have this into place immediately. Then there are obviously FMCG and FMCD companies, which are consumer durables and fast moving consumer goods, which will get benefited if they can realign themselves with this current situation. You know, Conceptually, there is something known as a deferred demand and a delayed demand. When you talk about a deferred demand, is like, okay, I wanted to buy air condition today. Okay, so I might not buy an air condition today, but maybe 4 or 5 months down the line, I will go ahead and buy that air condition. So it's a deferred demand or a delayed demand. Okay, so that's where companies need to cash in on if they use this kind of an opportunity, with a lot of brains behind it. But then there's something which is known as a demand which is lost, where you have your airlines, you have got your tourism, travel, which is totally gone. But so that's one area of the business will suffer. But this set of businesses can really, cut down their costs, use different ways of marketing, use technology, and do the best in their sector.
Okay. Uh, so, which sectors should a new entrepreneur enter in the current scenario?
Well, that's a toughie actually, if you ask me. I mean, which sector to enter? Okay, in a very layman way, we always say the basic needs of a human being is roti, kapda, makan. That's what they, that's what we talk about.
Yes.
Your discussing. So I think one of the sectors which can do good is the food and beverages. Okay, so I travel a lot, so I've seen you know I've seen a lot of different places and countries where uh, there are hardly any kitchens at home. There are hardly any places where people are doing their own cooking. So restaurants flourish. Delivery of food to home flourish. So that's one area, that is a food part, which can really do well, going forward. So if an entrepreneur can start up with a very small startup with, where he can deliver quality food with, with right pricing, they can do very well going forward. Again, the sector which I earlier talked about, if you can have a good, if you can match up the demand and the supply between, consumers. So I'm not talking B2B. I'm more focusing on B2C, okay, business to customer, where if you can be a link in that, you can flourish in that business also. So as entrepreneur, if you're wanting to start a business, there is obviously, as I told you, there is food and beverages as an option which you can start off with. You can have you can go the technology way and become a middleman, and you can link the customer and the business together, which would do good for you, and for you'll benefit the society as a whole. The other business is teaching. I think teaching will do very well going forward. There are a lot of students, a lot of people who need guidance. They need a lot of I would say margdarshan, जिसको हम बोलते हैं हिंदी में. They need that kind of so online teaching, or online tuitions. That's going to be something which can really pick up going forward. So that's one area. That's a third area where you can build up a company or build up. So we have talked about I don't know what Byju's is there, I think, as an app where a lot of learning takes place. So that's one area which I think can do well. For that, you need to self-orient yourself and become good yourself before you can start teaching people. But that's another very good area to start your business in, if you're an entrepreneur. So I'm now subjecting it to entrepreneur because I think that's a question to start a business.
Yes, absolutely.
Yeah, so those are the things.
Okay. The next question is asked by Siddhi, and it is an extension of our previous question. What will be the future of investing in this current pandemic with slow economic growth and development?
Well, okay. So I will take you a little back. I want to take all of you a little back. Let me tell you a story. In 2001, there was 9/11. If you can recall, the Twin Towers in USA, they got, there was a plane which got struck at them, and it all collapsed. And and at that point of time, the story was, Dow Jones and Nasdaq almost stopped for a week. So there was no trading in Nasdaq and Dow Jones for a week, and everybody during that 1 week decided that the airline industry is going to go zero. There will be nobody who's going to be flying airlines. There will be fly the airlines. There are going to be 2-3 commandos who are going to be on the airline, and that's it. So that was the future of airlines would go totally downhill. So after 1 week, when the markets opened, all the airline stocks which were listed on Dow Jones and Nasdaq went one way down. That happened, and exactly 3 days after that, all of them recouped all their losses and were up again on their highs. It's about sentiment. It's about your understanding of a situation. And from that day till today, the airline industry has grown 27% year on year throughout the world. I will share a very nice, instance for you, which you like. Around 4 months back, the number of people who were, flying airlines in India were higher than the number who were traveling by train. So, you understand that one instance, of bad news created so much of a problem. That was 2001. Then there was another instance of a lot of pain in the market, which came, I think, in 2008, where the Lehman Brothers crisis, which took place, and the markets again crashed. Even our, Sensex and Nifty, which is our indexes, they crashed very, very badly, almost like close to 61%. And there also, I think at around mid 2008 and end 2008, everybody said that, okay, that's it. The index has come down to, Nifty is down to 2,500 levels, it's going to come down to 1,000. At that point of time, I remember asking myself, will the index become zero? I mean, is it possible that the index can go to zero? I mean, that kind of, a sentiment which is there. And that day and today, the markets have gone up close to, 7 times. I mean, imagine if anybody had that kind of, foresight to invest during that, downward move in the market. So he would have invested there, and today he would have made 7 times the money in the also what around about 11, 12 years. So these are huge crises, huge crashes which come once in a decade or once in a while your way, wherein the whole world has got only one kind of a mindset where okay, things are done, they're over, they're not going to pick up, there's going to be a lot of problem. But what happens is during these crashes, during these down moves, there is a lot of value which emerges. So like in 2001, when the airline, stocks came down, a lot of value emerged. So people bought in, they made a lot of money. In 2008, when the indexes came down so drastically, value emerged, okay, in the markets. That's when people invested. So it's like a discount. You go to a shopping mall and there's a discount, 40% discount, 30% discount, 60% discount. So, that's the way it is, So you have to understand that it's a, huge discount which you're getting something at a good value, which should have paid 100 rupees, but now it's available at 50 rupees or 60 rupees. So if you're buying something at 100 rupees and now it's available at 50, 60, why are you thinking so much? You should not. So unfortunately, this time around, it's a health crisis which has struck us, because of which, the whole investment, mindset has been very negative. Markets have crashed. They made a low of 7,500. I'm talking about Nifty more specifically. Now it's, I think, hovering around 10,000 levels. But again, when you will see it, maybe when you are 3 years down the line, you look back and you will say, oh gosh, we should have invested in the markets 3 years back when the valuation was so low. The price to book had come down to close to 1.2. Your price to equity was close to 13. So, I mean, these are times when you need to think a little contrary to what is happening in the world and in the investment gamut, and take a risk oriented investment option. So my personal answer would be that this, though wherever the markets are right now, is a very, very nice opportune time to go ahead and invest in. Keep the sentiments out, look at the valuations, invest now, and 4 or 5 years down the line, you will not regret it for sure. But invest rightly. Don't invest in penny stocks, or don't invest in companies which don't have a future. Just go ahead and invest in the right funds or right companies, and take good advice and follow that.
Yes, sir. Definitely. Do you think the investors will rely on secured or unsecured segments? Moreover, which industry will be more effective?
Okay. See here, we need to understand secured sectors. I'm assuming when you're talking about security in terms of the sectors, a secured sector would be maybe in IT. It's more of a defensive sector which we talk about. IT is a defensive sector. When markets coming down, people put their money into IT because it's got that advantage of dollar revenue. The weakening of the dollar helps IT. Then there is pharma. Obviously, pharma and healthcare is like is like hot property right now because of the the kind of crisis which we are in, and quite a few of those stocks are actually moving out. So these are defensive. They are that's where the money flows generally when this kind of a crisis comes in. But I think again, my whole mindset tells me that we will come out of this much faster. Okay, we will be able to come back to normal a little faster than what we had anticipated. That examples can come in from China, Wuhan, where you see the minute Wuhan opened up, and there was I think Chanel was one of the shops which opened, which was the biggest shop in the world, and that did a 20 crore business within a day. I mean it's a brand which people went ahead and just bought. And then if you talk about New Zealand, which is again on zero, you have Japan, which is back to its normal life. You have a place like I think Spain, which has got restaurants opening up, where people are going and sitting and having the beaches have opened up in Australia, is what I understand. So things are going to change fast. So here I would suggest that don't only look at the defenses or the secured sectors. I think you can venture out in companies which have really come down in valuations. The sector would be like cement. Cement will do very well. Fast-moving consumer goods would do excellent because once things open up, people are going to rush and buy what they have, that void in their life of not having something. They want to fulfill it. Okay, consumer durables. So I'll give you a very interesting, example. So all of us are very dependent on house helps. Okay, we need a lot of house helps in our life. With this so-called 72 73 day lockdown, most of the housewives are going to start demanding a washing machine. Most of the men in the house would want to have a dishwasher in their house, because we have realized one thing, that depending on someone is not a very good idea at the end of the day. So I think the demand for dishwashers and washing machines would actually go up going forward. There was a lateral way of thinking wherein people would refrain from traveling from in public transport, so they would go ahead and buy cars, and they will buy bikes and everything. I don't know how that will unfold, uh, but that's how I see it. So there's going to be demand in cement, there's going to be demand in FMCG, FMCD. I think there's going to be a good amount of demand which will also come into slowly and steadily, not immediately, into infra capex oriented companies. And why do I say that? Like, the main problem which we faced was China was the only manufacturing place in the world. Everybody looked up at China. Well, now whatever you need, you get from China. But there has been a very big supply chain disruption because of China. They shut down totally. So a lot of goods and services which were imported from China by all these countries suffered. So there will be a lot of impetus on by the government, which they have already done, and they will further keep doing, is to go ahead and have manufacturing within India. I think multiple countries will look at India to maybe have a part of their manufacturing within India. So there is a top five countries which are known. I think the special five, which is the Jakarta, that's Indonesia. You have Thailand. You have India. You have got your Bangladesh, and you've got Vietnam. These five are called the Super Five, basically. Super Five in terms of wanting to go ahead and set up manufacturing units. So they will come here. So that will again create a lot of capex into India. So these are the four sectors which you should really look at: FMCG, cement, capex. For sure, keep looking at that. Pick out the shares or companies which are doing well in them and invest it for the next 5 to 7 years. You'll not go wrong in them. So these are the ones we should good luck. Don't be too very defensive. Go ahead and diversify into these kind of sectors also, is what I would say.
Thank you, sir. That was really helpful. Over to you, Bhagyashree.
Thank you, Sachi. Hello, sir.
Hey, how are you?
I'm fine. How are you?
I'm doing well, thank you.
Yes. The next question is from Sumit, who resides in Canada, and Prathamesh. So they would like to know which investments will hold strong in all market conditions, even in the declining ones. And what could be the asset allocation strategy during pandemic and economic crisis?
Okay, so these are basically two questions. So I'll answer the first one, then you remind me the second one, okay?
Yes, sure.
And that's going to be kind of you. Okay, so as such, there is no such investment which is evergreen in nature. Okay, every asset class and every investment goes through its ups and downs. It is very obvious. Uh, so here, what you need to understand is the longevity or your time frame or the period of investment, is very, very important for all of us. Um, Again, if you go to the basics and you talk about, if you talk about, like, I always give this example. When a baby is conceived, the medicines start coming into the picture. The folic acid is supposed to be given to the mother, and the mother goes on to medications. And until until you go on to your deathbed, you're actually having medicines throughout. So there's not a single age group which is not exposed to having medicines or needs healthcare. So I think one sector which I think has got a beautiful longevity would be the healthcare sector. the medicines and the companies which are in manufacturing of generics, which you can look at, but they will also have their cycle, obviously. And otherwise, if you ask me again, there are new sectors which are opening up, which are into insurance, like you have SBI, Life, which is there as a company, which is which is there on the browsers for investing. You have Nippon, you have HDFC Life, you have HDFC, mutual fund, which is also. So these are like companies which are going to stay for a very long period of time. Till you are there, they will be there, because people will invest, keep investing money. So I'm not going sector specific. I'm going company specific out here and business specific. So I'm looking at businesses, but a very long period of time.
Yes.
Give you an example. Let's like Gillette. Now Gillette is into shaving and creams and multiple kind of products. Now let's understand, Gillette is going to stay around for a very long time because people are going to use shavers. They're going to use shaving. So that's how the product line helps you to have keep forwarding and keep using it. Pidilite, which has got a brand called Fevicol. I mean, it's like a known brand, and people will keep using that product over and over their life to keep using it. Then there's a company called 3M, which is basically a trading company. It trades into multiple kind of products. It's again an excellent company because whenever there is a demand and a supply mismatch, they are there. Even few of the masks which I use are basically of 3M. That's another company. So I would say you have to be very company specific rather than sector specific, because they will go through their ups and downs.
Yes, sir, definitely. And what could be the asset allocation strategy during economic crisis, especially?
Oh, well, okay. So you need to be a little dynamic in your asset allocation. You can be very passive in it. You need to understand that times are changing. The news which are coming our way are very dynamic in nature. They change almost every day. The businesses are evolving very fast in our set of things. So you need to have a little dynamic approach. Don't be focused on only one asset class for sure. I think you need to have equity prominently as of now because of the crash and the valuations which are available right now in the market. You should have real estate, which is actually down and out right now, but I think over the next 7 to 8 years they will come back slowly. Gold also should be a part of your asset classes, which should be used and should be a function of your overall asset base. Then I think even looking at debt is not a bad idea. Debt would be either you go into funds of companies, or you can go ahead and buy company FDs, or you can go ahead and buy bonds of companies. Either you go through the mutual fund route, which give you different type of debt products, short term, medium term, or long term, which can be of good use. I think here I would say I would actually stick my neck out and say the credit risk fund should do well going forward in the debt side of mutual funds. So that should also be a part of your asset allocation, but be heavy on equity. So be heavy on equity, and in equity focus broadly on large and mid caps, because they are going to be the ones who would really reap the benefits of whatever has happened so far.
Yes, sir, absolutely. Moving on to a most asked question by the students. Can Nifty ETF be seen as a better investment opportunity?
Okay. Yeah. Okay. So let's understand what the Nifty ETF is first. Okay. So it's an exchange traded fund. You can buy it and sell it on the browsers. If you go onto the BSE or NSE, you can buy and sell it. Nifty ETF is basically, so you have Nifty has got 50 shares. Okay. Now those 50 shares are in exaction compiled into an ETF. So there are 50 companies in a Nifty. Those same 50 companies are going to be there in the ETF. And as and when you see up and down within the Nifty, that's how basically the ETF will generate returns for you. So give an example, like today Nifty is at 10,000 and it goes to 12,500. So in a very simple way, if you park today, like say X, some amount into a Nifty ETF, that will grow by 25% from here. So if you park 100 rupees into a Nifty ETF and the index goes to say 12,500, you will make a 25% return. There's a tracking error involved. which is obvious. There is a little bit of a tracking error, so it might not be 25%, little less, but almost the same. The costing of an ETF is very low. It's much lower. So yes, ETF can come across as a good option to invest because the markets have corrected so violently on the downside. So you can put a part of your money into Nifty ETFs also. Should not be. So there's a Sensex ETF also. I don't know why Nifty ETF. You can park into a Sensex ETF also. But here, when you're talking about alpha generation, so what is an alpha generation? Let's understand that. Now we have got 50 shares in Nifty, but that's what it's called, Nifty 50. Out of those 50 shares, 30 might do well and 20 might not do well. Okay. When you park your money into a fund or with some fund manager, he might go ahead and actually select those 30 companies which he thinks are going to do well going forward. Okay. So one option is to go and buy a Nifty 50, which is exact replica of the Nifty 50 stock. And second is to choose a fund manager who has done a brilliant job of tracking the funds, tracking the shares, and he selects those 30 companies, and those 30 companies actually go much higher. So you'll make more returns by investing in a fund rather than an ETF. So what I would suggest is go 50-50 or go 75-25. So park in an ETF also, but also use a good fund to generate more alpha. That is more returns for you. That would be the suggestion.
Okay, so diversify your assets basically. That's what you need to do. Yes.
Always.
Yes. So do you think the ETFs will outperform mutual funds in the long run?
Okay, this is a very interesting question. These are the kids who have asked the question, or the students are asking these questions, right?
Yes.
Yes. Okay. So, as I explained, like when you talk about Nifty, there are only 50 companies, which are there in the whole gambit. Now, it's very obvious that all 50 of them cannot perform at the same length and cannot have the same performance going for them throughout the time. So there will be 20 or 30 of them who would, perform really well, and they'll outperform the Nifty if they are kept outside the Nifty. So here, when you go to a fund manager or a fund house or any of the funds which are available, and they have selected the right kind of companies, so they would select maybe a cement sector, maybe a auto sector, maybe a IT sector, and maybe a Capex, oriented companies. These four sectors do very well. So in the Nifty component, these are those 30, companies which are of these sectors, and he has selected it for you. So they will do brilliant. They will do very well. They will create a lot of money for you. But if you end up, going with a fund house or a fund manager or some of the people who have not selected these companies and they've selected a laggard, he will not be able to, outperform the Nifty, obviously. So here, it's very simple. The selection should be such that it's not necessary that Nifty ETF will always, surpass the return of a fund. So it's not very obvious. It cannot take place generally. It might not, but the universe is a Nifty, and out of that you select certain stocks which will do well. So I would say not always. A very rare case that you select a good fund manager, a good fund house, and a good fund, and he would actually deliver better returns than a Nifty, is what I would suggest. But if you want to be safe, go with Nifty 50 or Nifty 80. If you want to be safe.
Definitely. On that note, how are hedge funds thriving in this current crisis? And how do you think they're able to maintain their positions in the current market scenario?
Okay, so hedge funds generally take a very contrary view. They are contra in nature, and hedge funds also, like arbitrage funds. There are arbitrage funds also which are there in the market. They both play a very important role, pivotal role in the markets and the volumes which are there in the markets. So if I'm a hedge fund, I really did very well in the last from 2008 to 2017-18 period. I did extremely well because my contra views really worked very well. I made a lot of money for the clients. I hedged my, so it's, what is a hedge fund? Let's understand, like, if you have got gold, gold becomes a very good hedge for equity. When equity came down, so like, let's take an example. Like if you take 1 year back return, gold has actually come up by 30%. So it was, in India terms, gold was around 33,000, 34,000 rupees for 10 gram. And now it is close to 46,000 rupees. per 10 gram. And and the equity markets have actually come down, in a similar proportion. They've come down by 25-30%. So a hedge fund would have gone ahead, taken a contra review, he would have gone invested in gold, and he would have hedged his position in equity as against the investment which he has done in gold. So what would have happened is he would have not made a full loss. He would have reduced his loss because he had invested in gold, and that's the hedge. That's how hedge basically works. Going forward, I think hedge funds and arbitrage funds both will do well. They can be an option for investment, but I think in both the cases, there is a little bit of thinning of margin which is taking place. Some of the yields have gone even negative, so you have to be a little careful before investing and select the right fund, hedge manager who is managing your money before you go ahead and park your money in that.
Yes, sir, definitely. That was very well explained. Over to you, Sachi.
Thank you, Bhagyashree. So, sir, we now have a couple of questions related to the real estate sector. This question is from Rohit. Under the current scenario, will investing in international real estate be a better option? If yes, how will it affect HNIs and which country is favorable for Indian investors?
Okay. Okay, so real estate abroad. I mean, if I talk about UK, if I talk about Europe, if I talk about USA, generally, if you invest your money in real estate there, the kind of ROI, return on investment, which you get is close to around 4.5-5%. Which means when you take into consideration India, I think it's close to 2.5-3%. So when you're investing a similar kind of amount abroad, you get a better ROI than what you're getting in India. Real estate is very specific in nature. It's very, very, I would say, it's subject to a lot of demand and supply and how things work. So if you want and look at ROI, obviously investing abroad for return on your money is a very good idea because it's higher than what you're going to get in India if you invest in the property markets in India. So I would say maybe UK, USA, Canada, they seem to be a good option. In India, if you ask me, I think the low-cost housing is going to do very well going forward. The spacing 360 square feet or 450 square feet kind of arrangements will do very well. I think they will pick up because low-cost housing is something which is really required by all of us. There are many people who still don't own a house but want to own a house. So the amount of flow of money which goes for a low-cost house is much lesser. Investment-wise, you can invest in India also on real estate, but I think a week, 5 or 6 days back, there were some talks that the developers need to reduce their rates. They need to bring the rates down because there is too much of supply and there is very little demand in real estate in India. So that's one thing which might drive real estate prices going down. But having said that, I think in the next 5 to 7 years, if you're able to park your money now over the next 1.5-2 years in real estate in India, I think the yields which you will get through rentals would be close to what you're maybe getting out of India, maybe close to 4 or 5%. Here I'm assuming that the interest rates which people are paying for buying a home or buying a house will also come down. And other relative investment avenue returns will also slowly and gradually keep coming down. So that's how I see it going forward. But abroad, maybe UK, USA, Canada, yes. In India, wait for another year or two. Maybe let's see the prices coming down and invest, and it should be a part of your asset for sure. Real estate or a house or a home or a commercial property can certainly be a part of your investment for sure.
Thank you for the insights, sir. The next question is from one of your acquaintance, Mr. Kedar from Mumbai University. He has a small message before we move to his question.
For sure.
Hi, Rahul. Not sure if you remember me from MET. It's good to see you guiding investors.
Oh, that's really sweet and kind of you. Yeah, you're continuing. Sorry.
No, it's fine.
Okay. No, yeah. Kedar, yes, he was a colleague when I was doing my MBA. So yes, I very much remember you, Kedar. I'm sure we would have done few presentations together. And what is the question he asked? What is this question?
Yes, sir. His question is on investment in physical gold. His gold investment allocation is approximately 13% of his portfolio. Last few days have seen a drop in gold prices due to weaker US dollar to other currencies. With the US presidential elections approaching in a few months, US dollar and equity markets usually are stronger. Do you have any thoughts on this?
Oh, yeah. Okay. Well, Kedar, and to all of you, my first, take on gold is in the next 2 to 3 years, it will keep going up. So, if you go back in history and see, gold had a very, had a period of almost 8 to 9 years where it did not really move. It was just, oscillating between 27, 28,000 rupees to around 32, 33,000 rupees. It really started an upwards trajectory close when we had that when we had the airstrike on the POK. Okay, that's from that. I think it was around 33, 34, 35,000 during that time, and then it started moving up. It's almost been a year plus, and today it's around 46,000. The reason I think gold will go up is because it had a very long period of consolidation. It's consolidated for almost like 8 years between this range. So 13% is a good allocation in terms of percentage for any asset. I know it will go up. It should ideally keep going up because it is also a safer haven. And with this so-called, economic problems which are going to come our way, I think people would want to allocate some of their money into gold also. I cannot give you a target, but I think it should give you 8 to 9% annualized return going forward. So yes, Kedar, first of all, congratulations. 13% is a good amount of allocation in gold. I hope you had invested around 2 years back, so that made good returns. And going forward, yes, gold will give good returns. So yes, it should be a part of your portfolio, but get equity also now. Equity also will give you good returns. No two ways about it.
Thank you, sir. That was really informative. Over to you, Bhagyashree.
Yes. So, P. Naik has asked, could the budget prepared before the pandemic struck go for a toss now, and will it impact the companies adversely?
Okay. I'm sorry. You need to. My apologies. Can you repeat the question?
Yes, no problem at all. Could the budget prepared before this pandemic struck go for a toss now, and will it impact the companies adversely?
Let's see. I mean, here we need to understand what is a budget. Yeah. He's talking about the budget, right? The budget which
Yes,
was
the union budget.
So, like you want to go for a trip. So when you want to go for a trip, you would budget the expenses. Okay, I need to book a ticket from here to wherever place you want to go, staying expense. The kind of expenditure you might have when you are traveling. So budgeting is the budget which is put up across to us. The union budget is basically just an estimation of the expenses which you would have and the income the government would have going forward. Obviously, when the budget was presented, we were not we did not even have an inkling that we will be stuck with a coronavirus or a COVID or a health crisis which we have. And this is unprecedented. We have never seen something like this. Being staying at home for 70 days. In a cage. I wouldn't say it's a cage. It's like, but still, you're like so restricted in your life. So it was unprecedented, and obviously the budget did not have that kind of inkling about it. So obviously there will be a little bit of pressure which will come onto your fiscal deficit in the budget because you have won the package of 20 lakh crore which has been been put into the system. So where does that money come from? I mean, what are the options where you raise that money? So that will obviously put a lot of pressure on the fiscal deficit. I think we were close to around 3.3%. I think we will go up to close to around 5.2% now. So that will be a very big, move in terms of in the budget. But there are some good pointers also where crude has come down. We budgeted around $60 a barrel. That's what we budget for when we're talking about oil. But now I think the Brent crude is close to around $33, $35 a barrel. So that down move is also very, very good for us. wherein it will help us to reduce our deficit. But then, if you look closely, we had a $60 billion trade deficit with China. With this 2-3 months, there is hardly any trade which has happened. So that trade deficit will also come down. So all these will positively and negatively impact the budget. But yes, certainly this question is valid. I thought something will happen, and that totally did not happen. Something more contrary took place, and I was obviously not prepared for it. So yes, there will be a pressure on the union, on the budget, and how the money goes in and how the income. GST has been impacted very badly. There is hardly any GST income which is there. So yes, it will be a problem, but I'm sure the government will take care of it.
Yes, hopefully. The following question is related to banking and financial services. So what do you think would be the impact of the increased moratorium period on the financial services companies and increase in NPAs?
Okay. That's a good one. So, in this, the market, in overall, the banking market, there is almost a liquidity push of 8 lakh crores which has come in. Apart from obviously the 20 lakh crore package which was given, plus the kind of CRR and the repo and reverse repo rate which have been used. So there is a lot of liquidity which has come into the system in the hands of the banks. When you look at the moratorium period, please try to understand, moratorium period is not a deferment, it's just a deferment of your payment. But eventually you have to pay that money.
Yes.
So I would broadly, classify the problem into two areas. One would be, the kind of loan which has been taken by people. So when I talk about a non-performing asset, I would see, people who have taken small personal loans, or people who have taken loans for very smaller kind of businesses. I think they would suffer very badly. So, NBFCs which have given loans, or banks which have given loans to very small players, or mostly NBFCs give those kind of loans, private or for their working, they are going to suffer. So that's where the NPAs would rise. But when you talk about the broader, you talk about the corporates, and you talk about maybe the infra-related companies which have taken these loans, I don't think they will default a lot. So their defaults will be much lesser. So NPAs on books of companies which are giving loans to these kind of companies would not have too much of a problem. But I would take you a little more deeper and make you understand about NBFCs, which were actually growing stupendously in the last, last 5-6 years, where they were giving a huge amount of loans to MSMEs and other smaller players. Their books will get a little strained. I think their NPA around 4 or 5 months back was close to, the net NPA was around 3.6. With this moratorium period setting in, and if there are not, I think that can almost double. The NPAs can double for them going forward. But I hope as a country, we have not been a country of defaulters. We have been a country of, I don't know why I'm saying this, but we have too many examples of defaulters, unfortunately, right from Vijay Mallya to quite a few of them. But I'm hopeful that the defaults would not be that huge. We'll be able to come back into reckoning in terms of businesses and in terms of economy, and payments will be done to the banks and to these NBFCs. So let's keep our fingers crossed. But yes, there will be a lot of strain. So don't go ahead and invest immediately into them. Just let the results come of July. So that I think, April, May, June, results will come in July. You go through the results of all the banks and all the NBFCs. Look at them very closely, how they have performed, and what are their receivables, and how well they are in terms of risk management, basically managing risk, and then go and invest in them. So just wait for a month before you go ahead and invest in these kind of companies.
So banking and financial services needs to be hold on for a while.
Just wait for a month. Let the results come.
Yes. Yes, since we are living through a pandemic, we received a lot of questions regarding the insurance and healthcare sectors.
Okay.
So how are life insurance companies managing their positions in the current market scenario?
Okay, so we here they will do pretty well because here I think the mortality rate of people actually dying because of coronavirus is very low in India. I mean, thanks to God and thanks to all the maybe precautions we have taken and thanks to the lockdown we have taken, the level of mortality is much lower. That is one. Second, we are a year back I think there was a health scheme which was given by the government. To 5 lakh rupees insurance was also covered for the rural and the semi-rural area, people who cannot afford it. Uh, as a 133 crore population, which we are currently, I think healthcare is a very huge sector to grow. I mean, we need to look at this as a very good opportunity. We need to understand that insurance as a product is to safeguard you, and the probability which the insurance companies play with and the healthcare system plays with is much lower. So they will not be impacted too much. I think I'm actually having a different outlook. I think there will be people who will actually go in for insurance now. They will actually go ahead and buy health insurance. They will actually go ahead and buy life insurance now because of this pandemic. They have realized the importance of being secured in life. So they will do well. I think these companies should do well going forward if they again use their marketing and their branding properly. And healthcare should do phenomenal. We need healthcare. We need a good amount of healthcare in our country. So there are quite a few companies with Apollo Hospital. I think there are quite a few which you can look into if they have that kind of a mindset to grow. So I think I'm contrary. I think they will do well. They will not get impacted too much. I think their sales should go up, is what I personally believe.
That was a very good perspective. Another area of concern for majority of households is that how much percentage of total income should one invest and in which financial instruments, considering children's education and retirement planning?
Okay, so here the thumb rule which we start with, I'm sure I have shared this with all students of mine, is like you have an income, okay, then you've got an expense. So when you minus your income from your, when you minus your expense from your income, you've got something which is called as savings. Now, savings in your bank account are of no use. They are hardly giving you any returns. But if you go ahead and park those savings into an investment avenue, which can, generate returns, that's where money makes money. So the thumb rule out here for all of them who are listening out here would be first clearly jot down your expenses, understand your expenses, minus it from your income, and whatever is left is to be parked into a product or an avenue which can generate high returns. So it can be a fixed deposit, it can be a recurring deposit, it can be a postal national savings certificate, it could be a PPF, it could be equity funds, direct equity, it could be bonds. And why do you need to do that is actually the second question which you asked me. So we develop funds and money over a period of time as per our goals. So you could be having a goal of child education, could be having a goal of buying a house, could be having a goal of prepaying a loan which you have taken for your house or a personal loan. Retirement is a goal which is imminent for all of us, which is related to passive income. Today I'm working actively, I make active money, I've got salary, I've got business, which comes my way. But when I retire, I don't have this kind of money because I'm not active. So I need passive income. So where does that come from? For all these goals, you need to start slowly and steadily investing every month or every half yearly or yearly, whatever. Product-wise, to have a good, so how should I explain this? Okay, so let's take an example. I think that will make our life more easier. So supposedly I have a 2-year-old son, and I know when he turns 20 or 21, he is going to be doing his MBA. Now today, the average cost of doing an MBA in India would be anywhere between 4 lakhs to as high as 25 to 26 lakhs. So when I talk about 18 years down the line, it's very obvious that there is going to be inflation, which is going to go ahead and increase the cost of education. So maybe which is costing, so I take the higher end. So supposedly it's 25 lakh rupees, which is an MBA cost today. I think in the next 18 years, it will go 3 times up. So I'll require 75 lakh rupees to do his MBA. Then he turns around 21, 22. So I need to do my back calculation and come to a figure which I need to start investing every month, which will build up to that amount, 18 years, down the line. So that's what you need to do. That's one. Where to invest is again a good question. So if you have got a longer time horizon and you think, so 18 years is again taking the same example, I think you can look at equity and hybrid kind of investment where you have to take a little bit of risk, but because you have got a higher timeline and you have got a lot of period in hand, you can take that risk asset and try to generate more alpha. So a fixed deposit will give you around 6.5%, 6%, and maybe your equity fund can give you around 9-10%. So 9-10% obviously will grow your money much faster. So use that as a option for your child education. And what was the other one? Child education. The one
retirement planning. Retirement planning.
I'll dwell a little bit on retirement because that is something which is imminent, something which is going to come our way irrespective if you want or you don't want. And I personally believe retirement is more for state of mind than an age. If I've got money coming into my account regularly, I could be in a retirement stage any which ways because I've got passive income which comes my way, which I can use to have a good lifestyle. I can use it for my expenses. So to reach that level, one, you need to understand what your current expenses are. Because those are the ones which will obviously give you a yearly. So suppose you have an expense of 20,000 rupees per month, that grows to around 2,40,000 rupees a year. So 2,40,000 rupees today in the next 10 years would develop very easily. So your expense after 10 years would be close to around, say, 5 lakh rupees. So now if I want 5 lakh rupees after 10 years, every year 5 lakh rupees, which is required by me to take care of my lifestyle and my expenses, what kind of amount I need to have in a fixed deposit or into a bond to give me that money. So well, if I consider 10 years down the line, fixed deposit would be at 2.5%. That means I need 2 crore rupees to be there in a fixed deposit, which will give me 5 lakh rupees passive income every year, which takes care of my needs. So that's how you basically in a very nominal way plan it out. So retirement, very important. Start planning now, start investing now.
Yes, definitely. Over to you, Sachi.
Thank you, Bhagyashree. Next, we'll come to a question that I'm sure every Indian wants to know the answer to at this point of time. What are your thoughts on the 20 lakh crore package announced by the finance minister?
Okay. Yeah, everybody is so, they are like, oh, the 20 lakh package, am I getting that 15,000 rupees in my account or no? Okay. So that is that calculation everybody has done. But please try to understand, the package which has been announced by the government, majority of it will take almost like 3 to 4 quarters to get into the system. It's not going to be something which will come immediately to us. Majority of it is directed towards the MSMEs, towards the people who are doing small businesses, because getting the wheels of the economy churning is very, very important. So, like as I told you earlier, almost like 8 lakh odd crore rupees is there with the banking sector today. With the repo and the reverse repo rates which have been reduced, this money can go and can be borrowed by people like us at lesser rates. One, and at the same time can be used to buy or go ahead and invest in different areas which they have not been able to do so far. So it's a demand supply kind of work which takes place whenever you have these kind of packages. These packages mainly aim at expenditure. So I'm giving you money. When you spend money, you give money to somebody else. He gets that money. He goes ahead and spends that money. So it's a cycle, economic cycle, which starts off. That's what US has been doing for the past 12, 13 years. That's the reason their GDP to debt is almost 325%, and ours is only 125% so far. I think more than the package, what the government is waiting for is to see how much of a damage these 70 or 80 days have done to the economy. So this was more of a monetary and stimulus package. I think the major, the real move will come when the fiscal package comes from the government. That's what you should look forward to. This 20 lakh crore package is good for MSMEs, it's good for businesses, it's good for maybe the higher end of the pyramid, but the lower end of the pyramid, which I think will come through the fiscal package which the government will give. Post, we come to know what kind of damage it has done to the economy over the next 1 quarter. So I would say thank you for the package, but not a very, very immediate, it's like a band-aid. It's not like a foolproof problem solver so far.
Thank you for sharing your perspective, sir. The next question is a very interesting one from Nikhil, and he'd like to know what exactly is cryptocurrency and how to invest in it. Is cryptocurrency investment recommended during the session?
Okay. Uh, Cryptocurrencies, yes, that's like a favorite of quite a few investors. I think cryptocurrency came into play as a substitute for normal currency. Like you have, it was an idea uh, wherein you could trade goods and services for digital money, which was encrypted in nature. It was an idea which stated that money would not have barriers of boundaries and countries. Any person staying anywhere could go ahead and buy and sell by using the crypto. One of the most widely used cryptocurrency is the Bitcoin, which everybody is interested in because it is used widely by people to trade even today. Microsoft, by the way, as a company, allows Bitcoin as a payment option. So that's another bit which is very huge. Uh, it has not picked up that much. It could not really compensate, or it could not really take away the banks and the forex totally away. Uh, People are still interested in cryptocurrency as an investment option rather than a trading option, if you ask me personally, because they think that when they invest in cryptocurrency, maybe a Bitcoin, the value will go up, they'll make money. So if I invest in a Bitcoin, which is trading at maybe say like 1 rupee, it will go up to 1 rupee, 20 paise, 1 rupee, 30 paise, and I'll make the 20% or 30% return by buying the Bitcoin today. Um, I really don't know about how the cryptocurrencies will work because now, along with Bitcoin, there are others. There is Ripple, which is another currency, cryptocurrency, which has come into the picture. So already there's a lot of competition, and this whole system of cryptocurrency is based on demand and supply. So if there is suddenly there is less supply of this currency and the demand is very high, the price will go up. Uh, I think 2 years back there was a huge crash in the Bitcoin price, where people lost a lot of money. The understanding of this, cryptocurrency is not very high amongst people. Uh, so do people do make losses when they go ahead and buy it? But I think it's at a lower end. I think it again corrected around a week or two back. You can use it as an option to diversify and pick. You don't need to buy a whole Bitcoin. You can buy a part of it. But yes, you can, but it's your own call on cryptocurrency. It's something which you don't know where it's headed, to be very frank.
Well, thank you for shedding light on this topic. Shreya Bendre from Canada has asked how to analyze companies 2 to 3 years down the line with current pandemic impact in mind.
That's an interesting one. So I would like to see how a company has been able to take care of the cash flows, how they have been able to really reduce their expenses, how they have been able to realign themselves with the current market situation. Uh, to give you an example, like when you talk about restaurants, quite a few restaurants were able to deliver thanks to Swiggy and thanks to other options plus their own delivery systems, and they were able to survive this period. Similar kind of instances can be seen in online, when you have these online portals, which have done brilliantly in raising capital and have gone ahead and used this as an opportunity to get people into, like you have got Netflix, you've got Amazon. Okay, so these kind of companies have done, brilliant. Then you had so one of the biggest beneficiaries would be a Bharti Airtel. The company shares have gone up. Uh, because people are going to go ahead and go digital. They're going to use network. They're going to use a lot of such companies which are into the technology. So 2 or 3 years down the line, I would have gone ahead and looked at all these factors. I would have looked at more closely how they went ahead and used this. I mean, I should not be saying this, but use this pandemic as an opportunity to go ahead and market or go ahead and push their sales. So that's what we will look at when we go forward. I've already talked about the sectors I think which will do well. So Shreya can go ahead and look at the companies within the sector.
Thank you, sir. That was really helpful. Bhavesh wants to know how liquor stocks will perform in the near future.
Liquor shop, liquor companies.
Yeah.
That's Bhavesh, and he's a student. Huh? Interesting. So liquor would do very well, I think, going forward. The breweries would do excellent. The reason is very simple. We saw the kind of gate crashing which happened, the kind of social distancing norms were flaunted when you allowed wine shops to open in Mumbai and in other states. People flocked. I think in Kerala or Karnataka, I don't know which of the places, they suddenly clocked in a very high number of sales immediately when these kind of shops opened. So what I have realized is, liquor is like a 24/7, 365 day kind of a beverage which everybody likes to have. तो बोलते हैं ना गम में भी पीते हैं और खुशी में भी पीते हैं और कुछ काम नहीं हुआ तो भी पीते हैं. So, that's the way it is. So I think go ahead and invest in United Breweries or UBL. Go ahead. I think there was some COVID tax which was levied by Delhi government that was also removed. Even when the taxes were levied, even then the sales were taking place. So I think taxes got nothing to do with liquor consumption. So it will keep growing over a period of time. So not a problem. You can go ahead and buy.
Thank you, sir. Mr. Satyam Kesarvani wants to know, from education perspective, which field is going to be in demand post-COVID?
That's a very, very interesting one. Which field is going to be in demand? Okay, so I had mentioned FMCG and FMCG, but I would go a little bit online. I think online startups would do very well going forward to reach out to people. So that is one area where if you can go ahead and work yourself in, I think that's a good sector to find a good job or try to start an option. I think food and beverages. So you have got a company which is Jubilant Foodworks, which is another company which is there, which is into franchisee model. They are going to do very well. So go into companies which are into food and food distribution kind of a sector. I think today we are in a kind of a situation where we need to really look back and understand that things are not going to be the same. Things will change very fast. So if you're looking at marketing as an option, or you're looking at strategizing as an option, or strategic, if you can become a strategic developer or a strategist in your field, I think that will help you a lot. Then there are fields like lawyers and doctors, which are evergreen. So I don't know how can you go into that now, but company secretarialship, that's another very good option which you guys can take up. CS is what we call. If you can do law now, if you can pick that up, it's a good option. So yeah, these are the areas where you can look at. But again, don't be so very, don't get so very enamored by the situation. There will be every field which will require people. Every sector will require people. It's not that suddenly people will be substituted by machinery, people will be substituted by artificial intelligence. That's not going to take place. So if you are good and you have taken the right kind of initiation in terms of your knowledge, and you have geared yourself in these 70 days. So one of my students has given multiple exams online. So even banking and finance is going to be a very good sector to get into. So don't think, don't narrow yourself. I think there's still a lot of opportunity to go ahead and take advantage of.
Thank you for the guidance, sir. Over to you, Bhagyashree.
Yes, thank you, Sachi. So what should an ideal mutual fund portfolio should look like given the current situation?
Oh, wow.
The students want to know.
Well, you know what? So my YouTube channel, There's Smith Talks, which is there. talks about different funds and where they are actually, investing money, and which are the funds which we analyze in terms of, different ratios, like Sharp, Tenure, Jensen. I'm sure you both would have taught you guys these ratios along with standard deviation. But if you talk about a good fund, I think go for a multi-cap fund now. Multi-cap fund would mean that it has got large caps, it has got mid caps, and also it's got small caps. All three different kind of caps, entailed in them. So a person who does not want to take too much of risk and is just starting his investment, then he can go ahead and invest money into a multi-cap fund. But if you are a little bit of a risk seeker, and you can take a little bit of risk, I would go ahead and say that look at large and mid cap, funds. So a little bit of exposure in mid caps can do well, because a mid cap company can become a large cap. So that's the kind of, so it creates more alpha, can create more money for you. So look at maybe, large and mid cap funds also. So that's the kind. And the portfolio is sector oriented, a little less on banking and financial, more on maybe, consumer, more on durables, more on cement, more on capex, more on manufacturing, more on I would say I would say IT and pharma. So if these sectors are there in that fund, park more money there, and that's how you should go about investing.
Definitely. Thank you, sir. The next question is from Gaurav Gohil. He wants to know real estate UK versus mutual funds in India. Where should I put my money?
Okay, that's a very, very interesting question. Okay, so here when you go to UK and you park your money in the United Kingdom, try to understand the borrowing rate is very low. And what happens is if you borrow money there and you park your money into a real estate in the UK, if you put it on rent, the rental income supersedes your loan amount outgo which is there yearly. So it's to give you an example. So if you buy a property of X amount in UK, so if you are getting a rent of say £1,000, per month, your interest or the mortgage interest which you're paying to the to the company will be close to around say £700. So £700 is your EMI, and £1,000 is your monthly income through rent. So you're making a positive £300 I would say money. So that's money which you're making. Well, it's a very interesting question because you're talking about two very different asset classes. And one of the asset classes, which is equity in India, has corrected very drastically. And, we have not made really great returns in the last 3.5, 4 years. They have hardly given any returns. And this is a similar kind of a time which happened from 2008 to 2009-10, where returns were not there in the equity market. But then a beautiful bull run started, where markets really doubled your money in a very short period of time. A similar kind of instance took place in 2001, 2002 in the equity markets when there was a crash. And then when the markets moved up again, they really moved up brilliantly. It was a beautiful bull market. So I would say that if you talk about India and investments in India and the equity market, I think we have created a base for the next bull market to start in India, which can start maybe in the next year or so, or it's only a base which is created. And if you have a time horizon of next 5 to 7 years, I think India equity would give you much, much higher and substantial higher returns than the option which is real estate in UK, because we're on the verge of a start of a bull run. But again, I would say diversify. Don't go put your money into only one thing. Park a little bit there and park a little bit here. So diversify it is what I would suggest.
Yes, definitely.
Sir, Rege sir wants to know why share market is going up despite of COVID and bad economic situation. Is China a threat for us?
Okay, question. So, we need to understand the markets, analyze and markets understand what's going to take place, what's going to happen much before we can. So, in March, when the correction took place in the markets, it took into consideration almost 6 months of no business. So that's the reason the markets came down close to by 35%. So Nifty, which was at 12,500, it came down to 7,500. Why did it come down? Because it stated, it automatically analyzed that, looking at the situation in the world, 2 quarters of earning of all the companies is going to go down the drain. So when that happened, the prices which were at 100 came down at, say, 65. That's how the Nifty corrected from 12,500 to 7,500. Today, when we have gone through the lockdown and we have gone through the stress period, and we're looking around India, things are actually coming back to normal slowly and steadily. So the engines and the train, which had suddenly stopped on a station, has now started slowly moving out of the station. So the wheels of the economy have started to move. So what I'm understanding is that the market had realized that we are going to come back to normal over a period of time, maybe next 2 or 3 quarters. So that is what has been factored in. So that is one of the reasons. Second, I would say there is a little bit of liquidity which is coming into the market thanks to the package which we talked about, the 20 lakh crore.
Yes.
But beyond that, I think even the FIs have started moving in. And one of the reasons I think, Regis sir, is there is an MSCI index, which is the Morgan Stanley Country Index, and the FTSE FTSE. In both these indexes, India has been allocated a higher percentage of investment grade. So the FIs and the people who are investing in India are looking at the MSCI index, and they are looking at FTSE, and they realize that they need to park more money into India. So that money is also flowing in. There is a lot of short covering which has taken place in the markets. So that's the reason for this huge, sudden move which has come into the markets. But they will sustain. I mean, there could be a little bit of a bump down, which will come. But I think we are going to get back to normal, and we need to be positive. We need to be optimistic about this. And I'm sure jump back to normal, and we'll have colleges and schools and everything. And hopefully be back to normal soon. So that's the reason. These are the 3 reasons for us.
Hopefully things will be back to normal. Akanksha Pednikar wants to know, what is your perspective about investing in media sector-based companies right now?
Media,
yeah.
Okay, it's a hot sector. Media is a very nice sector to be investing in. Specifically, if you are into online media companies, not many of them are listed, but if you can, you should park in media, because going forward, we have realized that these kind of situations, if they occur again, we have all of us can go to only one. We can see a lot of movies, we can see a lot of series, and we can see a lot of see a lot of TV, television, and get scared. So media is evergreen. I remember 10 years down the line when internet came into vogue, everybody said that newspapers are going to go out of vogue. Newspapers koi padega nahi. Newspapers koi haath mein lega nahi. Books koi nahi padega. There will be nobody will be reading books. That's not really transpired. That's not really happened. So media is evergreen. This sector is a good sector to be in. It's a very lively sector. Be it entertainment, be it information, be it the growth is good for a sector. So yes, you can look at companies who are into this area. It's a good option. You should invest.
Thank you, sir. This is a question from Rugved, sir. Generally, all mutual fund managers talk about strong correlation between macroeconomics and stock market. What is different this time that all are just talking about reopening and ignoring reality?
Okay. So it's very, there is a dichotomy which is going on. I agree with what he's saying. The reality is not aligned with what is happening in the markets. I can understand that. But again, what we are looking at is a situation which was unprecedented, which had never happened earlier. Nobody would have thought in Jan that we were going to be locked down for 70 days. So, here you need to, how I see it is, 70 days down the line, you would look at things which would be a little normal. A year down the line, if we don't have a second wave of, coronavirus or COVID-19, fingers crossed, I think we would be back to normal. Like, I'll give you an example of New Zealand. New Zealand, everything is open now, except, the flights going out and in New Zealand. Right? So everything within New Zealand is very normal now. So people are going to pubs, the restaurants are open. The same is happening now slowly in European nations. So here I assume I'm assuming that sir is talking about the markets, why they're going up, and how come the real situation is really bad. The cases are going up, every day in India, and there is obviously a lot of stress within the economy. But I think the market is factoring in a different scenario 6 months down the line, and that's the reason it is moving up. And generally, I would say the markets generally are right. So, I mean, I hope this time also it comes true and we are in good place 6 months down the line.
Thank you so much, sir, for your insight. Over to you, Bhagyashree.
Thank you, Sachi. I think the next question will appeal to all the newcomers in the market. So, as a beginner to the markets, how can one start to understand the new terms and use them to analyze the markets? Request you to suggest some books or websites. Question asked by Shubham Shetty.
Yes. So, no, there is Prasanna Chandra. He's a very nice author, and his book's name is Investment Analysis Portfolio Management (IAPM). That is a very good book to follow and read if you want to understand how you can start investing, and if you want to get into a subject of analysis. Then there are there is Vikas publication, which we also go through in our life, which is your investment analysis portfolio management, the book itself, which is available, which you can read and which you can go through and understand. Then there are books by Peter Lynch, who was a Fidelity fund manager, which you can go ahead and pick up and read. So I'll talk about the authors, and then you can pick up the books. So there is Benjamin, who is very good as a writer. Starting to invest, that's a very good option, which you can go ahead and pick as a book and read. Obviously, you can go online and search on Google for Warren Buffett and his thought processes on investing. If you want to go and understand the different jargons and some of the jargon specifically, I would suggest pick up a dictionary. That's the old school way of doing it. Pick up a dictionary, read an article, and whichever words you don't understand, go to the dictionary, understand the meaning of that word, and understand it. You can go to my site also, which is I write blogs, which is Wellsmith Talks. You can go there. I keep writing about different areas in a simpler language. You can read that. So I think these are what you have to do. So go through them. They'll help you.
Definitely. So to conclude with, I would like to ask, what are the 5 most essential money matters that one needs to attend to in these crucial times?
Okay, the 5 most essential money matters. Okay. Number 1, please keep your expenses in check. We generally we go overboard with our expenses. It is a thumb rule that we should keep our expenses under control. Number 2, very importantly, keep a contingency or emergency fund available at any given point of time, because this period has taught us that we should have some amount available to us when we need it in an emergency or a contingency. This was an emergency where all the banks and everything is shut. You don't have money, where do you go? So that's number 2, very important. Number 3, please invest your money keeping goals in mind. Have very clear defined goals, be it retirement, child education, housing, or maybe even a travel trip. Keep that in mind. Do your back calculations so that when that goals arrives in your life, you are not shortchanged. You're not caught unprepared. So that's number 3. Number 4, I would suggest to keep yourself well insured in life. Have a very good health insurance. Have an excellent life insurance. Even a general insurance like maybe a car insurance or a home insurance is very important in life. Don't miss out on them. If these kind of maturities come your way, they can really suck all your savings out, investments out. So if you're insured, they really give you a lot of support. And number 5 would be, please stay happy. Be positive in life. Might sound a little philosophical in nature, but I think we have stopped to be positive in life, and we have become too very negative. So be positive. Work on yourself. When I say work on yourself, work on your health, work on your mental and your physical abilities. Learn, use knowledge, uh, try to do courses, keep giving exams of different nature, so that you have personal development also taking place. So these are the 5 things which I would suggest.
That was very informative, sir. Thank you. We have one last question. We just got it now from France. So Angelica Vaz from France wants to know, due to pandemic, collaborative software products may step up to a new level of long-term demand, having demonstrated their utility in an assortment of remote working situations. What is your take with investment perspective in software companies?
Well, so right at the beginning, I said that IT and software companies would do pretty well, because now a lot of companies which will look at bridging the gap between B2C, that's business, and a customer, by this software which is available to them, where they can maybe push their marketing, or they can push their sales, or they can push their relative products. So I'm very sure that going forward, this is going to be one sector which will really do very well. Even companies which have not been relying on software for their own personal management of HR or different areas of their functioning, are actually going to require software to integrate people within their system and integrate their processes. So it's a very good question, and I would suggest that yes, pick up these kind of companies and certainly invest in them. They will do very well, because the whole business mindset is going to change and become online and become software oriented going forward.
Yes, sir, definitely. This has indeed been an enriching and insightful session. And now, on behalf of the Finance Club and the Internal Quality Assurance Cell of ML Dhanukar College, I would like to propose a word of thanks. We offer our sincere gratitude to Mr. Rahul Mehra for sparing time from his busy schedule and being with us here to address our participants with insightful information and awareness in the fields of investments. Indeed, we feel very privileged for having you on board with us, sir. We thank our respected principal, Dr. Diem Doke, Vice Principal Srimati Chandana Chakrabarti, Course Coordinator CMA Sarvottam Rege, and our faculty, Ms. Shivani Naik, for their encouragement and support. A special thanks to our faculty, CS Swapnil Shenvi, for his support in executing this event. Our team, comprising of Ayush Bangera, Nitesh Kadam, Aditi Bhanshe, Nivedan Murutkar, Nupur Naik, Rachel Dantis, Vishal Bhandare, Samruddhi Zende, Sachi Patil, and myself, Bhagishri Raut, sincerely thank our audience for the overwhelming response and active participation. We do hope that this session has been beneficial to you all and wish that these key learnings provided about investments and their strategies help you prosper. The link for the feedback form will be shared on the WhatsApp group. Kindly fill in the same, and we will be sending your e-certificates in the groups. So kindly do not exit from your respective WhatsApp groups. Thank you, stay safe and stay healthy.
Thank you so much.